There. Okay. We'll do the hard one first. The cash budget. I meant what I said the prior class. You needed to use just about every single piece of information that was given. Some of you were getting thrown off because you only had to do it for 1 month. You could have laid out the whole thing for 3 months and just given me the 1 month, but the process doesn't change. What we were just trying to figure out is from the accrual basis for July, for anticipated sales and expenses for July, what are we going to spend in cash? What are we going to get in cash? And that's all we were looking for. The trick was trying to read what they were asking you to do and translate it to numbers. Some of you, the first 6 times, did the cash budget backwards. Okay? You started with July collections and then said, well, in July, we're going to collect July, August, and September. You can't collect sales that haven't happened yet. Okay, the collections are lagged. So in July, you were collecting a little bit of May's, a chunk of June's, and half of July's. So that what you needed to do was, if you want, however you wanted to set it up, the way we did it in class, the way we did it in the table, but you would have been looking at from May, June, and July's sales. Okay, you were given their dollar sales, and you're told that they are lagged, that collections occur over a period of 3 months, and that there is a 2% uncollectible. Okay, some of you kept trying to put that in the cash budget. It's uncollectible. You're not going to collect it. It doesn't affect cash. It's part of your sales, but what's going to happen is that's going to become bad debt expense and an allowance for bad debts, no cash involved. So that what you needed to do, if you work backwards for May, you were going to collect the remaining 8% of May. That was 2 months out. June, you were going to collect the 40%. And in July, you were going to collect 50%, but only 98% of that. If you know your bad debts are there, you take them off the top and you work it from there. So when you were done, you should have had collections of $42,720. And some of you tried to do July, August, and September. Well, if you were doing a September cash budget, that would have been fine. But all we were looking for was narrowly 1 month, what are we going to collect? Now, the next one, that the reason I sent the note to the whole class is you had to realize that your dollars in sales are using a different cost basis than your dollars in inventory. These are valued at $30 a unit. These are valued at $20 a unit. So you just can't add your dollars and figure out what you want to buy. You needed to translate it to units, figure out the units you needed to buy for the month, and then translate it back to dollars. This literally would have been the apples and oranges analysis. Okay, they are not the same base. So that you first had to figure out what do we need in sales in terms of units. Well, if we're selling $48,000 at $30 a unit, that means we're going to sell 1,600 units in July. If we know our beginning inventory was 16,000, that is carried at $20 a unit. So that we know what we started with were 800. Our desired ending inventory, you have to look for the policy. It's based on, it's almost always based on some percentage of next month's sales or next month's cost of goods sold. Right? And in this case, you're told that our desired ending inventory was 50% of the next month's sales. Well, that would have been August sales, which were 50,000, and sales are carried at what? $30 a unit. So that we're going to sell 1,600. Our management inventory policy says we need to keep 834 units extra on hand. We had 800 to start the period. So that means we needed to buy 1,634 units. All right, and for some of you, again, that definitely was not going to be intuitive. That was why I sent the note. Oh, now we know. We've got everything in units. Now you can multiply it by, well, what do we carry our inventory at? $20 a unit. Okay, so we need to purchase $32,680 worth of inventory. Just like our customers pay us, most of them pay 1 month, in the same month, 1 month later, or 2 months later, our policy is we pay half of that in the month in which we buy it, and the other half in the next month. So that, yes, we're going to buy this in July, half of it's going to be on accounts payable for August. So our actual cash collections in July are only half of that. And in June, we would have paid half in June, half in July. It's always lagged one month. So what would have June's been? June's would have been the accounts payable for the 50% we didn't pay for in June. So that our cash payments for inventory were $31,340. You may be off a little bit if you rounded. I think I had some numbers that were definitely a little bit lower if you rounded. So as long as you did the process correctly. All right. But you have to be careful about that when you're given dollars. If you're mixing sales and inventory, the unit is not worth the same in that total of dollars.
My question is, for the example we did of this in class before the
Right.
actual problem for homework, the inventory that we started with was, it said like it's some ratio of the cost of goods sold.
Right.
Unless otherwise specified, is it always just the sales for that month?
No, you'll be told what the policy is. For some companies, it might be 25% of next month's cost of goods sold. Or in this case, their policy is they want to carry half of the next month's sales.
No, that's not what I mean. I don't mean that. I mean for the sales, for the first line. And
Right.
like either inventory required, which was one example, or in that case, it's sales.
Sometimes they're going to give you units. Sometimes they'll give you dollars.
Okay.
It's just the way the problem is framed.
All right.
So we did one that was in units, and then that's why I emailed everybody saying you got to get this one to units first. Okay.
I think what he's asking is kind of where I struggled at the very beginning.
Go ahead.
Because when I looked at the example that we actually did in class, the very first item under the payments was the cost of goods sold.
Right, because they were basing everything on cost
So
of
it
goods
said in the
sold.
problem, then it specified that it was,
Right.
that's where it was coming from.
Okay.
Yeah, I'm just having trouble with the starting point.
Yeah,
Got it. Okay.
in the beginning I was struggling with the same thing.
Okay, and see what they did is this is what we had at that point. So if you knew your selling price, you could get it to units. But yeah, each company is going to approach it differently. This is managerial accounting. There is no gap. There is no one right way to do it. However they approach it, whether they use cost of goods sold or sales to base everything on, yeah, you just have to read it. Okay. How about for the test? I'll put it in bright red. Okay, so you don't miss it. But again, if you've not worked with this stuff, it's not intuitive. It really, you do have to. If you think of this in practical terms, somebody had to do all these little line items were somebody's job. I mean, somebody works on just worrying about what the purchases budget is going to be and where the numbers are coming from. And where does it back up to? Your sales budget. If this number is wrong, you can do all the numbers. Everything else is going to be wrong. It always goes back to the sales budget. All right, so whenever you're looking at payments, you're almost always going to be paying something from your purchases in the current month and paying off a prior month. And if you're really slow in your payments, you could even be paying some of May's off if you mirrored their own collection history. But usually you usually have a minimum for your purchases of paying off last month's accounts payable balance and then some portion of this month's actual purchases. The remainder of which, this $16,340, will be on the pro forma balance sheet as of July 31st as accounts payable, being brought forward to August. Okay. The next one, again, really required you to understand how variable costs differ than fixed costs, and you can't just divide by 12 and get your answer. Okay. You're told that for our SG&A, we have total SG&A of $186,000, okay, of which it's split 50% into fixed cost and 50% estimated into variable cost. Okay. So half of that 186,000 is, that means we had 93,000 was fixed cost. And 93,000 is estimated. This is what we used at the beginning of the year to figure out our predetermined overhead rate. Remember, once you use that, you don't use it again. All right, so our fixed costs, they should be fixed. They are for the year, so they are going to be spread out over 12 months, and almost everybody got to hear immediately. Yeah. That is our accrued expenses. That does not mean we paid all of those in cash. In reality, these fixed costs, some of these might be payables that you haven't paid yet. They made this very easy. They just said back out depreciation. But just because you're putting them on the July income statement, you could have salaries expense and salaries payable. It doesn't mean you paid cash. They made the problem a little easier by saying assume everything is in cash except for it's inclusive, so it includes the $20,000 annual depreciation. So you had to back out the depreciation. That was the $20,000 for the year spread out over 12 months. So you had to back out the $1,667 a month, whose entry is debit depreciation expense, credit accumulated depreciation. No cash involved. Think of the cash flow statement. If there's no cash in the journal entry, it doesn't go on the cash flow statement. Same thing with the cash budget. If it doesn't affect cash, it doesn't count. So our fixed costs for July are the difference between our accrued expenses and any non-cash items that were included here, the only one of which was depreciation. Usually you're backing out depreciation, depletion, amortization, depending upon what industry you're in. Other times you'd be given more information about there being payables that would need to be backed out. Because remember, our balance sheet and income statement are on the accrual basis. If we incurred the cost, it goes on the statements. Doesn't matter when we paid them. Whereas the cash budget wants to know when do we need the cash for. Now, variable costs, we know we have the other 93,000. Okay, so there's our 186. All right. How do we figure out variable costs? Variable costs are a percentage of sales. Sales minus variable cost equals contribution margin. So what we needed to figure out is, of the 93,000 that are variable costs, that's for the year, what were our estimated sales for the year? 720,000. So our variable cost as a percentage of sales, if I can read my own handwriting, is about a little under 13%. what that says is that out of every dollar of sales, almost 13% of each dollar is variable cost. How much do we have in sales for July? 48,000. So almost 13 of that was variable cost. So for SG&A, we're going to be paying $6,083 in fixed costs, $6,200 in variable costs. For purchases, we're going to be paying $31,340. Even though we're buying $32,680 in July, that's not what we're paying in cash. And then for our collections from customers, we're going to collect $42,000. So those were the three pieces that went into your cash budget. Now, questions? Okay, this one you had to go back to the prior chapters, and remember, you can't just allocate variable costs. They're based on a percentage of sales. That's your this is your predetermined overhead rate. Our predetermined overhead rate is 12.917 cents out of every sales dollar. So for each month, sales dollars are going to differ, so variable costs have to differ. Okay. Questions? Again, all this will be on Blackboard. So when you got all those pieces together, Part D was easy. All right, you just took everything you had and put it into a cash budget. And okay, so you know you'd have your heading for the month of July. Cash beginning had to be given to you. And again, we were just doing July, but a company would do for quarter, they do it for semi-annually, they could do it for a year. All we were worried about is for July. We ended June with $20,000 in cash, so we're going to start with $20,000. Our cash receipts, whatever you had in Part A. Okay, whatever you had in Part A, you brought forward. So we have cash available from what we started with plus what we collected from our customers, $62,720. Then you are, in most companies, they are going to list out payments to suppliers. And in this case, they only listed out payments for SG&A. Okay. Most companies are going to list out payments to suppliers, payments to employees. So those are the two biggest outsources of cash that you have in a company. And then they would list out other significant categories like advertising, R&D, if they purchased any capital equipment this period. All right, so they did, this is really lumped together just in two very high-level categories. You would expect to see a lot of different outsources of cash. Right. So payments to suppliers was Part B. Payments for SGA, whatever you had in Part C. Right. So that our payments to suppliers were $31,340 or $31,300 if you had rounded. Our selling and admin, the $6,083 plus the $6,200. So that our cash used is $43,623. So our cash excess or deficiency, we have 62, we spent 43. We end with 19,097. I would think they could have gone up as high as 19,150 depending upon how you rounded. And now, they didn't mention anything about what this company is required to keep. Okay. The fact that you didn't need to do this. The fact that they're starting with 20,000, this is probably what their internal cash requirement is. So ordinarily then, what they would be looking at is borrowings, so that you would have new borrowings of principal, you would pay back your principal, and you would pay back your interest, but there was no information about this. But if your internal requirement was $20,000, they would need to borrow $1,000 to bring themselves up to that $20,000. But since the problem is silent on that, that would have been it. Okay. So again, in any cash budget problem, I wasn't kidding. Every time you use a piece of information, underline it with a pencil or put a line through it so that you know you've taken it into account. Okay, so there's an example in, I think, in the middle of the chapter of a detailed cash budget. There's the one on Blackboard. This one will be on Blackboard. So you can see just the variations of how to read these problems. Questions? Then we went to a real easy one. Okay? Just thinking about, in the case, a company that, or companies, okay, just because it's technology doesn't necessarily mean it's a good thing. And what they have found is even still that with the electronic scanners, it's not the technology necessarily that's causing the problem. So what you have here are from Macy's, Walmart, Ames, Bradley's, all issues that were found and documented with their scanners. So this is going to be a whole bunch of different answers, and with the exception of part B. A and C, just depending upon what you identified as problems, then how would you handle them? So with the scanning errors, they really do think most of them are error instead of fraud. Where the fraud is when somebody's checking out a friend and you see the item go around the scanner. That's very different than scanning it and having it scan up a different number. So in terms of where you've got the human error, most likely caused by the failure to update price data in the computers. What are some of the costs these merchants or any others are likely to incur because of scanning errors? What are some of the problems? Scott?
Something could be mislabeled and it could go out and be sold for less than its actual value.
Okay, so that you have, it's basically mispriced. Is that what you mean?
Mm-hmm.
Okay, so it's mispriced, which leads to either lower sales, or it could be mispriced in the other direction, which leads to higher sales for the company, which are two completely different problems. Okay, what else can be a cost?
Increase in IT.
Is that?
Increase in IT.
Okay, an increase in IT costs. Okay, what else? Yeah.
You could lose out on customers because they might, you know what I mean, something might get rung up at a certain price, and then when they get home and check the receipt, it was rung up as more than they thought it was.
That's that one.
So
That if it's scanning at a higher price than you say it is, particularly if you've advertised it as being on sale, you can have customer dissatisfaction. Okay.
Loss of reputation. So if other people start hearing about the dissatisfaction, you won't get future customers.
Reputation issues. Okay, what else?
What about goodwill? Reputation. That's part of goodwill cost. Go to your goodwill.
Yeah. Yeah, you could think of it that way in terms of, yeah, it would be definitely eating away at what the company's goodwill is worth in the public. Yeah. Okay. Yeah.
You're gonna need like more labor hours. You get more customer service
Okay.
issues. Maybe
So you're going to have, right, increased labor.
restocking costs and things like that too.
So you have increased labor costs to deal with customers for maybe I don't know, it's shelving, maybe having to, with the labeling, if they're talking about having to label everything, pricing labels. stuff? Yeah.
I said time issues, because you're gonna have more people online getting like price corrections and also at the register, maybe the person's ringing them up, spending extra time correcting things or checking things.
And time issues at the register mean what? Increased labor costs, customer dissatisfaction, okay, it becomes circular.
Misrepresented inventory. So you need to probably have people take time out from other activities to go back and maybe recheck the inventory so you can get an accurate picture.
The scanning shouldn't affect your inventory. Well, depends how your system is set up.
I mean, what if that's how you track like what you have and what's going out?
But theoretically, you should be tracking your inventory cost. So that when you're scanning it, it's coming out of inventory at cost. And then whatever you're scanning it for is going into sales. Your inventory should be correct. Your sales will be wrong.
This one's kind of a stretch, but I put loss of employees. If the employees are constantly getting complained at by the customers, they might be dissatisfied in their job, and if they hire new people, it costs them hiring and training.
They can always go work for Target. Dissatisfied employees, okay. Okay. You did not have to get all of these. I'm just listing out possible ones.
One of mine, I put legal costs.
Could be. You can have, definitely. You get a bunch of consumers together who realize that they have been consistently overcharged at a particular chain. I don't know if you could get a class action suit, but you certainly could incur legal costs from individuals. Okay. Anything else?
Since you know that this is happening, you always need a prevention cost, because you know that this always will happen, so you need a prevention cost. In training to the people that enter the data.
So.
Test the system to reduce the scan error.
Okay, you're going to have increased testing of the system. Some of these actually now, they're increased costs, but they are actually solutions to the problems as well. All right, you're going to do increased testings of systems because of the problems. Mm-hmm. So this actually would be a part C answer. Okay. All right, so let me put that, just temporarily put that out here. That is going to be an increased cost, but it should be a solution cost rather than a problem cost. If we look at all the costs that are due strictly to the scanning errors, which one, where would you categorize them? How would they be categorized? You have 1 out of 4, so where would you put them?
I said external.
They're all external.
Because, yeah, they're all hitting the customer.
They're all external. As soon as it's scanned, it's external failure. You've made the mistake and the customer is the recipient of that mistake. Now, how you fix those problems is different. The costs you're going to incur to fix the problems are going to be all over the place. But if it's a scanning error, it happens at the register at the point that the customer is making the sale. The error has happened, and the customer is the recipient of that error. So that they all come out to be really an external failure. Yeah.
If we've brought in new employees, run them through an employee training process from the moment they were hired, and they were incorrectly advised on how to scan, is that still an external failure, even though we're the cause of the problem ourselves?
Well, what it is, you're gonna have it take a double hit. You're gonna take it under your prevention costs for training, but your training was insufficient. You wasted money on training because it wasn't the right training, and the result of that misspending and prevention are increased external failure costs. But yes, so you could have, right, if you did it the wrong way and brought that in, yeah, that would have been a prevention cost that didn't work. It didn't prevent it. Right, and then you could have brought up a whole bunch of them. But from something simple, from mispricing, okay, you buy a Frisbee and it's mispriced, you're gonna eat the 10 cents, the 50 cents, you're not gonna go back. You buy a flat screen TV and it's mispriced by $100, $200, you're not gonna be happy if you have to go back and, you know, go through the customer service process, particularly if it was around the holidays. All right, so depending upon the extent of what you're buying, because in these stores, in Macy's, you can buy stuff for $2, you can buy furniture for $4,000. So depending upon what you're buying and the magnitude of the mistake, that's going to determine the amount of customer dissatisfaction, your reputation issues, and everything else. And so going back to the training, okay, training would be one area where you want to spend, which is prevention, all right? But what else do they need to do to make sure that scanning error, how can they minimize the scanning errors? How can they minimize their external failure?
Implementing a new data management system that updates the prices better.
Okay, that somehow okay, this IT is more like this one, where that is a cost spent in response to the problems, so that they need to have the system better updated, so that when there is something on sale, it's reflected somehow a lot faster in the system that it's being reflected. What else might you do?
Try to make sure that people are tagging things correctly, like put more of an effort behind that.
Okay. That somehow you've got to make sure that even if you update the system, make the system more modern, somebody still has to go in and update those prices. So there has to be somebody who is in charge of appraisal and making sure that the changes are made to the system when they need to be made. Okay, but if having that one extra person is going to reduce most of these costs, it's going to be well worth it in the long run. Okay.
I think that doing some type of sampling periodically, maybe it's costly, but in some way try to do that.
Yeah, until you make sure that the changes in the system are done and that the training is done and that we do have somebody who's supposed to be checking the prices that are ringing up on the register against the prices that are in the system. You're right, you need to have increased appraisal costs. Remember that the only thing that will immediately stop external failure is appraisal. That's it. It's going to push it all to internal failure, because you're going to have to now relabel everything, and that's internal failure cost. But again, you're not going to have the customer dissatisfaction, you're not going to have reputation issues, you're not going to have legal costs. You are going to have increased labor costs for labeling the prices, but you won't have the unhappy customers. Okay? You won't have time issues at the register. Okay? You could have some dissatisfied employees because they need to do more than they had been doing maybe, but they're not going to have it with dealing with unhappy customers, which we've all been in stores where they've been an unhappy customer and it can get ugly. So anyway, this is just to think about how one small issue, theoretically, just the scanner not quite working all the time correctly, can lead to a cascade of external failure. And again, how to take care of that in the long run is prevention. And the prevention in testing and updating your systems, doing the training, setting up some sort of appraisal system that obviously isn't there. If they're constantly running into this stuff. The last thing you want is the state legislature to announce that in our state everything has to have a sticker on it, which is what it all used to be. You went into a supermarket, every single can had a sticker on it. Think about how much time that takes. All right, and for most states you don't have to do that anymore. The assumption is the system's working, which is not always true. Okay, anything else? Okay. Chapter 10, I I've got 2 or 3 that I want to go over. There are variations on calculating the different variances. So if we start with just exercise 30. Okay, that's looking at multiple product performance report. Right, so what we're doing here is they're not asking you to calculate actual variances like we were doing, the technical variances. What they're asking for is what's called a flexible budget performance report, meaning for what we actually produced, what should we have spent for that amount? So for our actual units produced, what was our budget? Because at the beginning of the year, if we budgeted for 10,000 units and we've only produced 8,000, of course we're going to have budget variances. But we won't know, are they due to us being efficient or inefficient, spending or overspending? It's going to be due to the fact that we made 2,000 units less than we planned. So that initial budget is adjusted to be what's called a flexible budget, to reflect for the units we did make, what should we have spent for the different categories. And in this case, we're looking at all of the categories for 2 different products. All right. And I'm trying to figure out the best way to put this. Let's see. The first thing you're always going to be looking for is what were the rates we set up at the beginning of the year? Those don't change for materials, labor, and variable overhead. Remember, whether we make 1 bike or 10, each bike still uses 2 wheels. Each bike still gets 1 set of handlebars. So that when we get our variable cost rates for materials, labor, and variable overhead, those are going to be then applied to our actual usage. So when we get those initial rates, they're not going to change. And so if we look at our, let's start with direct materials. Okay. What we had was, we have two products that we're looking at. We're looking at storage cases, 5,000 regular and 3,000 deluxe. And so when we make them for our direct materials, we have 2 direct materials. One is lumber and one is the assembly kit. And under each of the categories, we have a regular and a deluxe model. Okay, I'm not gonna work through every single line item here. I just want to get you started so you can see how this differs a little bit than the variance analysis. You could do all of your variances and then come back and stick the numbers in. In reality, that's what a company does. They're going to do all 8 variances and then roll them up into a report. This is sort of shortcutting to just looking at our actual versus our flex budget. Okay. And you're told that for regular lumber, it should be costing us $6 for a unit, 2 board feet at $3. For the assembly kit, it should be costing us $2. For the deluxe, for lumber, it should be costing us $9. Okay, 3 board feet at $3. Again, these are the standards that have been predetermined, that when we make these units, this is what we should be spending, this is what we should be paying. Notice we're not breaking it into spending and usage. We're looking at the bigger picture, just for what did we spend and what, for a unit, what was our difference between actual and budgeted. And for the deluxe assembly kits, you are allowed to spend $2 a unit. So there's no difference in the materials used for the deluxe assembly kits. And when we're looking at what we're trying to get to, what did we spend and what should we have spent for that level of production? So that for the regular, we should have spent, okay, let's put this, 6 times the 5,000 units, and we made 3,000 of the deluxe units. For the assembly kits, regular and deluxe, we made 5,000 of the regular and 3,000 of the deluxe. So budgeting wise, if we made 5,000 regular and we should have spent $6 per unit for labor, for what we actually made, we should have spent 30,000. For the lumber, for what we actually made, notice this is not what we planned to make. This is what we actually made. We should have spent 27,000. For the assembly kits, we should have spent $2 times the 5,000 and $2 times the 3,000. All right. So that what we should have had in the budget, our budget says we should be spending 73,000 for this level of production. Okay. Remember, the standard allowed for the actual units produced. So at this level of production, which is actual, this is what we were allowed to spend, which is the standard. What did we spend? 80,000. Our actual is greater than our budget, so we have an unfavorable variance. So we have a direct material variance of 7,000 unfavorable. Again, this is a much higher level report. You can't tell me where it happened. You can't tell me, well, did we use too much? Did we spend too much? So this is actually this is what comes after you do all your initial variances. You roll it all up into one performance report to report to higher level management. But this is not going to help you solve any problems. You need to know from this variance, okay, what was our spending variance and what was our usage variance. So we can see, did we spend too much for the material or did we use too much? This doesn't give you that information. This is the overall material variance. The same thing with labor and overhead. That when you're given all of the standards, so you would do the same thing for direct labor. You would put in your direct labor standards of $4 for the regular at 1 hour, $4 for the deluxe at 1 1/4 hours, and if you worked out all of the details, okay, all right, you would have for the direct labor variance, I mean, I can do this one. Actually, I'll just do this one. For the regular and the deluxe, you're given what we should have spent, what we should have used. So we are given it per unit. Our per unit standard is $4. No, I'm sorry, deluxe is $5 because it's 1 1/4 hours. And again, what did we make of each of them? We made 5,000 regular, 3,000 deluxe. So you end up with, we should have spent and used $20,000 worth of labor to make the regular. We should have spent and used a total of $15,000 labor to make the deluxe. So for this level of production, our budget is $35,000. What was our actual payroll? $36,000. So again, actual is greater than our flexible budget. So we have a direct labor variance, also unfavorable, of 1,000. But if your boss asks you to explain that, you're going to have to go back and find out what was the rate and the efficiency variances. Because you can't tell, was it due to too many hours used, or was it due to us paying more than $4 an hour? Again, ordinarily you're working this way. You're getting the variances and rolling them up. Okay, question? Because I'm going to need to erase this to put the overhead on. All right. Okay, this is all on Blackboard. Okay. For a complete picture, we've also got to do variable overhead and fixed overhead. Okay. We already know fixed overhead is not easily controllable. It is really the least important variance that a company is concerned with. Almost all of them calculated because it does give them the big picture and explains where a total difference between budget and regular is. For variable overhead, we're back same way. For regular and deluxe, our variable overhead, it's based on direct labor hours. And for variable overhead, for the regular, every time we make a unit, we're supposed to use $2 worth of variable overhead. Every time we make a deluxe unit, we are allowed to be spending $2.50 of variable overhead. Okay, so what was, again, we're back to, well, what did we actually make? We actually made 5,000. So our overhead should have been $2 a unit times the 5,000 actual units. We should have had in the budget 10,000 for variable overhead for the regular. We should have had 250 times 3, 7,500 variable overhead for the deluxe, which is a total of 17,500 in the budget. And you're told that we actually spent 14,000. Okay. So here, our flex budget, our budget is greater than our actual. So our variable overhead variance is 3,500 favorable. Okay. We came in under budget. But again, you can't tell me why. What we're doing is rolling up. Okay. And in fixed overhead, you're told that we actually spent 17,500. Okay. Budgeted fixed manufacturing overhead is 15,000 a month. Okay. So we have an unfavorable fixed overhead variance. Actual is greater than flex. A fixed overhead budget variance of 2,500 unfavorable. Okay. There is no volume variance because we're using a flex budget. Actual equals our flex budget. So there's no difference. If we were comparing to our original standard budget and had planned to make 5,500 units, then you'd have a volume variance. Okay, but we don't. We're just working with the 8,000 total units. So what you end up with is a favorable volume variance, an unfavorable fixed overhead variance, a $7,000 unfavorable labor variance, and a material variance, and a $1,000 unfavorable labor variance, so that our total variance is favorable, unfavorable, is 7,000, no, hang on for a second. Yeah, 7,000, yeah, 7,000 unfavorable total. And if you had added up your actual and your flex budget columns, you would have seen actual costs, which are given, of $147,500, and you would have seen the flex budget for materials, labor, and overhead for this actual level of production would have been $140,500. And so our overall variance is explained by these four categories, and then each of these would have an additional level that you would go down to explain them. Because if you just went in with this, they ask you a question about this, you don't have the details. All right? This is really the final step of a variance analysis. So again, it's just making sure you read carefully and figure out, okay, what do I need in the actual column? What do I need in the flex column? The flex column is actual production times your standard rate. Always. Questions on that? Joe?
3% still apply to this?
Yeah. But well, you can't really, yes and no. All right. Let me take that back. I wouldn't want you doing the 3% on a rolled up variance, because again, one could be 15,000 unfavorable and 14,000 favorable. This variance is going to show 1,000. So you don't want to make your decision on this. So in answer to that, no, don't use your significance level on a rolled up variance. You use your 3% on the individual ones. Because again, this 1,000 favorable, it could have been 59,000 unfavorable and 58,000 favorable. These are going to be incredibly significant. This might be totally insignificant. So it's why you never go with these numbers for an analysis purpose. What this is the cover sheet to all of the individual variances with the backup that if management wants to see it, it's all there. And they should want to see it. But you see why you wouldn't use this to make your decisions, because it could even be worse. Still $1,000 difference. Okay. So for somebody like IBM, okay, you could have incredibly large differences netting out to a small difference. Questions? All right. Now let's go back and look at actually doing the some variances. Which one do I do? 32. Okay, 31 and 32 are very similar, so 32 is going to be posted on Blackboard. 31 is going to be posted on Blackboard. I'm going to work through 32. Okay, it's asking you for variance computations and explanations. This is more of what you're going to do at a mid-level management analysis. Okay, what's going on for delivering the service or making the product in terms of our, what are we spending, what are we using, and being able to explain where all the differences come from. Okay, so if you look at 32, they make tenths. You're given the information on standard materials in terms of their cost. what you're allowed to spend, what you're allowed to use, what you're allowed to spend on labor, what you're allowed to use for labor. Okay, what we purchased for materials, what we used in production, what we used in labor. And it says calculate all standard variances for materials and labor. Okay, now that one is interesting because for materials, when they say all, you actually can calculate 3 variances here for materials. Your purchase price variance, your usage variance, and your a price variance based on purchase, price variance based on usage, and then a quantity variance. What did we actually use? Because here, purchase does not equal used. And the other problem we did last week, purchase equals used, you can only calculate one price variance. But when you're looking here at materials, our problem is you can do a material purchase price variance, which is going to be separate, and then you could also do a material price variance based on usage. That's the one you can net out and would have been reported in that roll-up report, because both the quantity and price variance are based on usage. What was the quantity used? Okay. This one is based on what was the quantity purchased. So this one stands alone. Most companies will do, if they do differ, they will do both. They won't pay attention to this one unless there are other issues, which we'll talk about. They'll worry about why is our purchasing agent not paying what he or she should be, and why are we not using what we should be. Right? This one is redundant. But if you're going to do a roll-up for a flexible budget, you need it. Because you can't net out. These are on 2 different bases, which listen, you'll see when we look at the numbers. Okay, for a purchase price variance, okay, what is it? Actual quantity purchased times actual price. Compare that to actual quantity purchased times standard price. So you're told that we bought 9,000 yards of material and spent $4.90 for it. But what should we have spent? If you go back to the bottom of the other page, our standard says we're allowed to spend $5 a yard. So for those 9,000, we were allowed to spend $5. Right away, we spent less. This is going to be a favorable variance. That does not mean it's good. It just means we're under budget. What are possible reasons for us to be paying less for this material? Why do we pay $4.90 instead of $5? What are some possible reasons for this variance?
It's lower quality.
Okay, could have been a slightly lower quality. It's not according to spec. What else?
Bought it in bulk.
Okay, maybe we got a discount, a bulk purchase discount that wasn't built into the standard.
Next supplier?
Okay, maybe we've changed suppliers and they want to get our business and they've cut the price and it's the same quality.
Some sort of natural material, maybe the whole, maybe more of it was found and it's become more available.
Okay, that maybe the market price has changed and our standard was based on a time when the material was costing more. Okay, think of it in reverse. Everybody that did their budgets based on oil and gas prices of a year ago is redoing all of their budgets. They're redoing all of their standards that are affected by that because gas didn't cost the same a year ago. And so there could have, again, that's usually the last possibility, but it is not that the standard is necessarily, quote, wrong, but that market conditions have changed and the standard no longer holds. It's not that a mistake was made, but at the time the standards were set up, that was market price for the quality we needed. And it could be now market price is $4.90, then we need to go back and change the standard, or if the market price continues to fluctuate, we just put this on the side and we don't worry about it. Okay, it's not the quote fault unquote of the purchasing agent, it's the fault of the market. Okay, and so this is $900 favorable. Okay. All right, I did not do my percentages. This looks like it's going to be unfavorable. I mean, insignificant. 900 divided by the 45,000. Okay, that should be less than 3%. Somebody could check that, but
2%.
Yeah. So this is 2% difference. 900 divided by the 45,000. We're not even going to worry about it. It's not significant. It could be that this purchasing agent did buy lower quality material, but until we do management by exception, we're not going to worry about it. Okay. Now, for actual usage, same idea. Actual quantity used times actual price. The middle anchor is what should we have paid, and the final anchor is what should we have used and what should we have paid. And what we're looking at here is for all of our variances, the flex budget. We made 1,700 tents. Doesn't matter what we plan to make for October. We actually made 1,700, so we need to see what we should have spent for the 1,700. Right. So that, actually, let me just get rid of this here. All right. And so it becomes, again, whether you do it by the formula, actual quantity times paren, actual price minus standard price and paren, or whether you do the anchors, you will get the same answer. We used 7,000 yards of material and paid $490. We should have paid $5. For the 1,700 real tents that we made, our standard said we should have used 4 yards of material, and we should have paid $5. So this one isolates price, this one isolates usage. Okay, so this comes out to be 34.3. Middle anchor is 35, and is 34. All right. So that 34.3, 30 versus the 35, we are under budget by 700 favorable, but we wouldn't be investigating this one right now because we would have already looked at this one and determined at the purchasing level, was there an issue or not? And the factory has no control over the price, so that even though we're calculating it, we wouldn't bother worrying about investigating it. 35 versus 34, we are 1,000 unfavorable. 1,000 over the 34 is going to be just about significant. 1 over 34.
2.9.
Okay. Not significant. You don't round it up. If it's 2.9, it didn't meet the threshold. We wouldn't bother investigating it. Right. What you would have seen on the flexible budget report would have been a direct material variance of $300 unfavorable. It would have been the netting out of these two. This is what it would roll up to on that report, but this would be the backup to the report, so if somebody wanted to look at this, they could go see where it came from. Okay. If this was significant, it's the domain of the factory manager. If this one was significant, it's the domain of the purchasing agent. Questions? So in this case, you calculate all three because for a performance report, you need to report it at usage, but for control purposes, you're using these two. For labor, the same thing, only we don't have to worry about purchasing being different than used. We don't inventory labor. So now we always have just the 2 labor variances still for our actual usage of 1,700. Okay. Our actual direct labor hours times the actual rate that we paid our workers. For the actual hours, what should we have paid our workers? And for the standard hours allowed for the 1,700 tenths, what should we have paid our workers? And so what you have is a direct labor rate variance and a direct labor efficiency variance. Again, no matter what they're called, the first one is what did we pay, the second one is what did we use. And so it becomes just look for the pieces that you need to fill in the blanks. That for the labor variance, we actually worked 3,600 hours and we paid an average of $12.50 an hour. Remember that average includes benefits. All right, so that's our average labor price, which could include anywhere from 22 to 30% of benefits markup. For those 3,600 hours, what did we budget? We know right away it's going to be unfavorable. We paid 50 cents more an hour than we should have, or than we budgeted. So this is 45,000. This is 43.2. And so we have an unfavorable variance of 1,800. 1,800 over the 43. That's going to be significant, right? I believe. 1,800 divided by 43.2?
Yeah, 4.1.
Yeah. Okay. All right. This is one we're going to have to investigate. It's greater than 3%. Remember, that's our threshold. Okay. So then the other anchor, for the 1,700 tenths we actually made, we were allowed to use 2 hours, and we were allowed to pay $12. So that anchor is 40,800. 43.2 versus the 40,008, 2,400, unfavorable 4. That's going to be greater than 4%. That's also significant. I think, right? 240, yeah. Is that right?
Yeah, 5.8%. 5.9.
All right. All right. In this case, they wouldn't be hidden. On that flexible budget report, you would see a direct labor variance. They're both unfavorable. They're going to get added together of 4,200 unfavorable. When you look at both of them, they are both significant. So now you need to go back and figure out, why did we use more than we should have? And why did we spend more than we should have? All right. We should have used 3,400 hours. We used 3,600 hours. So we used 200 extra hours to make the 1,700 tenths. Okay. Now, is there, what you first try to look at is there an explanation that would explain both of these? For example, if we had a favorable efficiency variance and an unfavorable rate variance, that might be explained by, well, these people are a little bit higher skill level than we usually have. Maybe they're better at making the tenths than the usual skill level. But in this case, they're both unfavorable. We paid them more, so this means we're using a slightly higher skill level on the line, but they also used more hours. So what are possible, what are the kinds of things you're going to look for to explain either or both.
Well, if it's a manufacturing operation, if they use more hours and they produce the same amount of units, it could mean that they had a couple of units that, you know, they attempted to produce that didn't come out right,
They,
seconds and stuff.
right, they could have trouble on the line, and that they had to stop the line, restart it, they had defects to pull off, it was just taking them longer to work than they ordinarily did, and so they could have been less efficient, so that you'd want to look at, again, because it is a significant difference, explaining why we're 200 hours over budget. And so you go back, and even though the material variances weren't significant, okay, inferior quality material can lead to a labor and efficiency variance. The materials don't work the way they're supposed to because they're not the quality you're supposed to be working with, especially for delicate machines. Okay, making tens, not so much. But, you know, in certain types of production, if you're the slightest bit off from your specifications from your material, the machines are just going to go haywire. They're not going to work right. Your labor force is going to have a harder time working with the material. And that works even if it's too high quality or too low quality. So you'd want to see, again, why the 200-hour increase. And one argument would be, well, maybe we have less experienced people on the line. Well, that's not true because of we're paying more. But what's one possible explanation that explains both? If we're paying people, if we have a higher skill level than is required for this job, these people may not be used to making the tens. This isn't their regular job. We pay them more for a reason. They have a higher skill level. So that if we have a few people thrown into this pool that don't usually make tens, absenteeism, flu, whatever, you know, that they, even though they have a higher skill level in general, it might not be making tens. So that because we're not using the prescribed skill level for the job, we might be using more hours. We're paying more in both ways. We're paying more for their money, for their services, but we're paying more in the hours used. So substituting a higher skill level doesn't mean you're going to get a better product because that's not their usual job. Think about on an auto assembly line. Somebody who's used to working with tires, you throw them in to work on the engine, your efficiency is going to go to hell. That's not what they do. All right, so that can happen on an assembly line as well.
I was just going to throw out, I was going to say that because in my facility, exactly what you just talked about, using a higher skill level, you know, we have guys that are there 20, 30 years, they do an incredible job, but to put them back down in a lower job to do it, they're not at, you know, they don't work as fast. So what we've actually done is taken individuals in a lower skilled job, cross-train them up, so,
Right.
you know, you're paying the same, you know, it's opposite of what
Right.
you're saying. We're paying a lower skilled
Right.
people to come up and do it, to combat that whole issue that you're talking about right there.
I mean, the way some companies do it, depending upon what their process is. Cape Cod potato chips. If you're ever up in Hyannis, you can go in and watch their process. Every hour, everybody changes jobs. Well, think about it. You really want to fry potato chips for 8 hours a day? You really want to work the bagging line for 8 hours a day? So everybody knows every job. Every hour they change, so it fights boredom. And so everybody's cross-trained. So if somebody's absent, somebody can step in. Now, granted, Toyota can't do that. You can't have everybody an expert at every single job at making a car, but you can have people cross-trained to do more than just what their specific skill is, so that you do have some flexibility in moving them around the line. Okay. What I just want you to start thinking about are possibilities. You know, each industry is going to be different, and until you're actually in this situation, you can't explain it. There's some things you just look for automatically. And again, if you've exhausted all other possibilities, then you go back and you look at your rates. All right? If you're a union shop, did we have a new contract come in and we forgot to update the rates? It's a possibility. Or again, is this 2 hours per unit? Has something changed that it is now taking us 2.1 hours? Did something change in our facility? And that standard is wrong. Don't give me that as the first answer. That's your last answer. After you've exhausted all other possibilities, the last thing you check is the standards. Because it's possible they're wrong. It's possible that they've changed based on economics. Okay. So that would be about it. What we're looking for in terms of, if you looked at all of your variances overall, what you would have, okay, when you're looking at Part C, trying to roll up your numbers and give the explanation, what do we have? We have direct material, price and quantity, direct labor, rate and efficiency. So if you take the 4 variances, the material ones based on usage, just for materials and labor, we have a $4,500 unfavorable variance. If we looked at our actual costs, our actual direct material and labor were $79,300. If you added those 2 far right anchors, our flex budget, if you added the 2 far other end anchors, are $74,800, and the difference is what? $4,500 unfavorable. Now, what a company's going to do is they're going to also have in here variable and fixed overhead. And you're going to have 8 variances here that explain your difference between actual and what we should have budgeted based for our actual production for the 1,700 units. If we had produced 1,800 units, everything would be different because those anchors would all be based on 1,800. All right? But what we've done is we can now explain our difference between actual and budgeted and by these 4. And we know that these 2 are significant and have to be investigated. What you would do is you would also see a significance here so that you would know that this one, which ones are the ones that you need to worry about. Okay. Questions? Okay. Let's see. That was 32. What we'll do is start 33. That's the last one I'm going to do. 31, as I said, is very similar to what we've been doing. 33 looks at materials, labor, and variable overhead and comes up explaining the difference in the units between actual versus budgeted. Okay. But in 33, you've got to figure out what the standards are. Okay, they're giving you a lot of the information. Now it becomes, okay, what are our actual costs and what were our standard costs per bag of dog food, separated into direct materials, direct labor, and variable overhead. Then they ask you to calculate, well, what are the variances? All right. So that, let's just get started on Part A, and then we'll take a break. Okay. So we're looking at problem 33. What they're asking you first is, before you even start doing a variance analysis, explain the big picture. Explain the difference between what you paid to make a bag of dog food versus what we should have paid to make 1 bag. What was our standard cost for 1 bag? So if you look at direct materials, okay, that they're telling you the standard cost for 8,000 pounds. They're giving the information at 30 cents a pound, 8,000 pounds, so on and so forth. And so what we want to do is compare the actual versus the standard or the budgeted for one bag. So for 1 unit of production. All right. So for our direct materials, we purchased 8,300 pounds at $23.78. Okay, and what we are looking at is these are the costs for a 1,000 bag batch, and what we want is the cost for 1 bag. So our actual cost for materials were $2.378 for 1 bag for the materials. Okay. For the standard cost, okay, we are supposed to have 8,000 pounds to make 1,000 bags, and we are allowed to spend 30 cents. So our standard cost for materials was $2.40. Okay, so what we're doing, this is what companies have to do. They have to go from a batch to a unit in order to figure out on per unit, because you're going to be making different numbers of units. All right, so that here's the actual that was given, and then here's so there's 1,000 bags in a batch. You do the same thing for direct labor. We spent $450 to make 1,000 bags, so that to make 1 bag cost us 45 cents in labor. For our standard, we are allowed to take 48 hours to make 1,000 bags, and we are allowed to spend $8.50. So for 1 bag, our budget is a little under 41 cents. For variable overhead, we spent $225 for the 1,000 bags, so we actually spent 22.5 cents. And for the standard, we are allowed to spend, based on hours, 16 hours per the 1,000 bags, and our predetermined so these are machine hours, our predetermined overhead rate is $10 per machine hour. So that we are allowed to spend 16 cents. So for this cycle, we actually spend $305. We should have spent $297. Our overall variance for the 6 variances that we know we're going to do, they have to add up to 8.5 cents unfavorable per bag. Now what we can do is explain, why is there a difference in material? Why is there a difference in labor? Why is there a difference in variable overhead? If you notice, most of these problems don't do fixed overhead. Because again, it's just not important in the big picture because they're generally not controllable. But we know now on a per unit basis what we spend and what we should have spent. Now we need to explain that. Okay, so take a break, we'll come back and then we'll work on that. I need to download that. Go to class.